Welcome to Breaking News to Trading Moves. So I want you to imagine for a second that you are the executive team at Apple. You have spent billions in capital and, well, more than 15 years perfecting the hardware ecosystem of the iPhone.
Right. It is their crown jewel.
Exactly.
Yeah.
And then you wake up and read a legal filing alleging that two of your former engineers just walked out the door with the highly confidential blueprints needed to build the exact consumer device designed to make that iPhone obsolete.
Yeah, that is definitely going to ruin your morning.
I mean, absolutely. So today, our mission for you, the listener, is pretty straightforward. We are going to take this specific tech headline, explore the facts behind all the noise, and clearly identify the market winners and losers here.
Right, because we want you to understand exactly how a single news item translates into actionable market dynamics,
Spot on. So the headline we are analyzing today is Apple officially suing OpenAI, along with those two former employees.
Yeah, and the core allegation here is the theft of confidential hardware information. Apple claims this info was used to accelerate OpenAI's move into consumer devices. Now, OpenAI firmly denies seeking or using any competitor's trade secrets.
Right. They're pushing back hard on that.
They are. So we are going to evaluate the companies that stand to gain from this friction, the ones facing new headwinds, and the underlying mechanical reasons driving those market reactions. And we are going to do this without exaggerating the impact because this is a targeted legal dispute at the end of the day.
Well, it sets up this classic battle of motivations, doesn't it?
Yeah.
OpenAI really wants to develop AI-first hardware to reduce their dependence on traditional smartphones.
Yeah, they want out from under those App Store fees.
Exactly. They want to control the actual physical interface you hold in your hand. Meanwhile, Apple absolutely needs to protect decades of engineering knowledge. I mean, things like thermal management, battery optimization, that is the foundation of its entire hardware empire.
Right. And when we look at this from a market perspective, a lawsuit of this nature has the practical effect of stalling a product timeline.
Because of all the legal tape.
Yeah, exactly. I mean, legal discovery processes require engineers to spend countless hours in depositions instead of, actually being in the laboratory building things.
Right, they're talking to lawyers instead of coding.
Exactly. And furthermore, the threat of an injunction hangs over the entire development process. So if OpenAI is tied up in litigation over the very hardware it is trying to build, the market immediately begins recalculating valuations for everyone in the surrounding ecosystem. And that is all based on that potential delay.
Because if a major player hits a bottleneck, the capital and the attention just rotate elsewhere.
Capital always finds a new home.
Which brings us directly to the potential winners. A potential breakdown in the working relationship between Apple and OpenAI creates a massive opportunity for alternative platforms. Let's look at Alphabet, ticker GOOGL.
Alphabet is in a really compelling spot here.
Yeah, because Apple still needs to offer top-tier artificial intelligence to its iOS users, right? If OpenAI transitions from like a reliable software partner to a bitter legal adversary, Alphabet is perfectly positioned to push its Gemini models further into consumer devices.
Well, yeah, and remember, Alphabet already pays billions annually to be the default search engine on Apple devices.
Right, those massive checks they write every year.
Exactly. So as search evolves into generative AI answers, Alphabet wants Gemini to be the default engine powering those localized queries. A legal fracture between Apple and OpenAI just removes the primary obstacle to that integration.
So they just swoop in.
Pretty much. Alphabet can offer a comparable product, ready to deploy through a simple API swap. That allows Apple to maintain its feature roadmap without relying on a company it is actively suing.
Wow, so that transition is seamless for the consumer, but highly lucrative for Alphabet. Now, moving beyond the consumer interface, we have developers to consider. Let's talk about Meta Platforms, ticker META, because they approach this from a totally different angle.
Yeah, Meta's strategy is fascinating here. They have positioned their Llama models as open-source alternatives.
Right, and corporate developers watch these high-profile intellectual property lawsuits, and they begin worrying about legal liability, don't they?
Oh, absolutely. I mean, they fear embedding a proprietary model into their software only to face future legal restrictions if that model gets tied up in an IP dispute.
So Meta provides a safe harbor for those developers.
Precisely. By offering open-weight models, Meta effectively grants a layer of legal immunity. Developers who are terrified of getting caught in the crossfire of Apple and OpenAI can just pivot to Meta's ecosystem.
It just makes Llama look like a much less complicated sandbox to build in.
Yeah, exactly. The legal trouble surrounding proprietary closed models basically becomes a direct marketing tool for open source competitors. It drives developer adoption straight toward Meta.
Okay, so if the developers are abandoning a legally complicated ecosystem to avoid crossfire, we have to look at the enterprise software market as well. And this lawsuit brings up a completely different sector of winners, which is cybersecurity and insider risk software.
Oh, this is a massive piece of the puzzle.
Right, because we are talking about allegations of former employees walking out with confidential schematics. I always like to say, modern tech employees are essentially walking security vaults.
That is a perfect analogy, yeah.
They possess local access to incredibly valuable intellectual property. So, do we usually see a direct increase in cybersecurity spending following these high-profile trade secret lawsuits?
We really do. I mean, when a lawsuit involving stolen hardware secrets hits the financial news terminals, executive boards at every major technology company pay immediate attention.
They get spooked.
Totally. The allegations put a glaring spotlight on insider threat monitoring and data loss prevention. Board members start asking their chief information security officers, if their own engineering departments are fully protected against a similar scenario.
I can imagine those boardroom conversations get pretty tense.
Oh, they do. And this urgency actually compresses the typical enterprise sales cycle. Budget approvals that normally take, say, 6 months, they get authorized in a matter of days.
Wow. Which points us right to the specific beneficiaries in the cybersecurity space. We're looking at CrowdStrike, ticker CRWD, and Palo Alto Networks, ticker PANW.
Right, because endpoint security is not just a standard firewall anymore.
No, it is behavioral software watching an employee's daily actions. Like if an engineer who usually pulls, 10 megabytes of code a day, suddenly attempts to transfer 50 gigabytes of proprietary hardware schematics to an unauthorized external drive.
CrowdStrike physically blocks the port and alerts the security team right then and there.
Exactly.
Both companies specialize in the exact enterprise architecture required to prevent data exfiltration. CrowdStrike dominates endpoint security, which means protecting the actual laptops and mobile devices employees use.
And Palo Alto.
Palo Alto Networks provides comprehensive network security, so they are monitoring the flow of data across the entire corporate infrastructure. Investors anticipate that enterprise budgets for data loss prevention software will expand immediately following this type of headline, which directly benefits those specific vendors.
Okay, so following that theme of mitigating corporate risk, let's transition from the AI platforms to enterprise-level CIOs. These chief information officers are actively rethinking their reliance on a single AI provider, right?
Yeah, they have to. It's a massive vulnerability.
Well, if you are running the IT infrastructure for a major corporation, I think it is identical to diversifying a financial portfolio. Like you would never put your entire corporate treasury into a single stock.
So are enterprise companies essentially diversifying their AI models just to avoid getting caught in the crossfire of one company's legal battles?
That is exactly what they're doing. Businesses are becoming increasingly wary of vendor lock-in. To mitigate that risk, enterprises favor multi-model platforms.
They want options. Right. They want the ability to access various models so they can switch between them instantaneously based on performance, cost, or, in this case, legal viability.
And the company providing that multi-model safety net is Amazon, trading under the ticker AMZN. Amazon Web Services offers a product called Bedrock.
Yeah. Bedrock is key here.
I like to think of Bedrock like a universal travel adapter. If a developer hardcodes OpenAI directly into a corporate application, they are stuck with that proprietary plug.
And if OpenAI faces a legal injunction, that application just breaks.
Exactly. But Amazon allows enterprise customers to plug into a single API gateway. If one model becomes legally unviable, the enterprise just flips a switch and routes their queries to Anthropic or Meta. And they do it without rewiring their entire cloud infrastructure.
Which is huge for them. I mean, a major material advantage for Amazon. It allows customers to test and deploy multiple alternatives safely. However, certain organizations prioritize even stricter rules.
Like banks and hospitals.
Yeah, companies in heavily regulated workloads like banking or healthcare, they just cannot risk any intellectual property contamination whatsoever. They require absolute transparency regarding the training data used in the models they deploy.
Right. They can't afford a single lawsuit. So for those highly regulated organizations, the market looks at IBM, ticker IBM. IBM has built a robust business around governed enterprise AI systems.
They really have. They appeal directly to companies focused on strict compliance.
Yeah, and they offer indemnification, right? Like
Oh,
essentially promising their enterprise clients that the AI models are free from stolen intellectual property.
yes, exactly. When IP disputes dominate the news cycle, IBM's focus on transparent, highly governed AI becomes a very attractive selling point. It creates a stark contrast in the market.
How so?
Well, while consumer tech companies battle over hardware patents in court, IBM approaches the Fortune 500 with the promise of boring, predictable, and legally safe artificial intelligence. Risk-averse enterprises will gladly pay a premium for that peace of mind.
That makes total sense. Boring is good in enterprise IT. Okay, so we've covered how alternative platforms, cybersecurity firms, and diversified cloud providers stand to win. But while diversification helps those alternative clouds, the capital rotating into those sectors has to come from somewhere.
It's a zero-sum game in many ways, yeah.
Right. That naturally turns our discussion to the losers. We need to look at the companies tied directly to OpenAI's infrastructure and the broader AI hardware supply chain. The most direct public market exposure belongs to Microsoft, ticker MSFFT.
Without a doubt. Microsoft maintains a massive financial investment in OpenAI. They have an exclusive cloud computing arrangement and deep product integrations across the Windows software suite.
It's all very intertwined.
Highly intertwined. Financial analysts model Microsoft's forward price-to-earnings ratio based heavily on the rapid, uninterrupted adoption of these AI integrations.
So a hiccup is bad news.
Yeah. Prolonged litigation or court-ordered restrictions on OpenAI's hardware development creates a real bottleneck. If OpenAI is distracted by a multi-year legal battle, that translates directly to delays in the consumer hardware assist revenue that Microsoft investors are actively modeling right now.
Got it. So analysts are forced to shave points off Microsoft's projected revenue, which leads to multiple compression for the stock. And a similar dynamic applies to Oracle, right? Ticker ORCL. Oracle supports large-scale OpenAI computing infrastructure.
Yes, they provide the massive server capacity required to train and operate these models.
Which isn't cheap.
Not at all. Oracle engages in massive capital expenditure to build out that data center capacity. I mean, they purchase land, secure energy contracts, and install servers based on OpenAI's forecasted compute requirements.
So if there's a delay.
If OpenAI's consumer hardware faces, say, a 2-year delay, the consumer usage of those AI models might not grow at the aggressive pace previously forecasted. This introduces the risk of stranded assets for Oracle.
Stranded assets, right?
Yeah, they could be left holding expensive server capacity that is underutilized, which pressures their operating margins.
Okay, moving down the hardware supply chain, we look at the chip and networking suppliers. Broadcom, ticker AVGO, designs custom silicon and advanced networking chips. The thesis here is that a delay in a major new consumer device category weakens the overall demand narrative for customized networking components.
Right. Broadcom faces weaker sentiment regarding the future pipeline of AI hardware outside the traditional data center.
But wait, here's where we need to examine the logic on NVIDIA, ticker NVDA. NVIDIA is listed as a potential loser in this scenario, which, I have to be honest, seems counterintuitive. I mean, since NVIDIA depends far more on data center AI than on one potential consumer device, why are they affected at all? A delay in a consumer gadget doesn't stop hyperscalers from buying GPUs, does it?
That is a very fair point, and you are right on the fundamentals. NVIDIA's direct financial exposure to a hypothetical OpenAI consumer device is virtually zero compared to their core data center revenue.
Right.
However, the market trades on future narratives. NVIDIA's current valuation premium relies on the assumption of continuous, friction-free expansion of artificial intelligence across all facets of life.
Ah, I see.
The market assumes AI will transition from the data center to the edge, meaning it will live on local consumer devices.
So the expectation is that AI processing will eventually be embedded in literally every physical product.
Exactly. And a high-profile legal battle stalling OpenAI's consumer hardware program damages that overarching narrative. If institutional investors begin to suspect that consumer AI hardware will be bogged down by years of patent litigation and trade secret disputes, the forecasted total addressable market, or TAM, for the entire AI sector takes a hit.
Okay, so it's a sentiment shift on the terminal growth rate.
Yes. It is not about NVIDIA missing a quarterly revenue target. It is about a chilling effect on that terminal growth rate. Institutional investors adjust their long-term sentiment, leading to downward pressure on the stock, even while the fundamental data center business remains robust.
Wow, okay. It alters the trajectory of the entire industry in their eyes. Institutional money moves based on the 5-year outlook, not just the current purchase orders.
Precisely.
Well, to close out our company analysis, we have to return to the initiator of this lawsuit, Apple, and examine his smartphone peers. Because for them, the outcomes present a real double-edged sword. Apple, ticker AAPL, faces a highly complex dilemma here.
It's a very tricky spot for them.
Obviously, Apple benefits if a potential hardware competitor attempting to replace the iPhone is legally delayed. But this lawsuit publicly confirms that Apple views OpenAI as a direct threat. And Apple recently announced plans to integrate ChatGPT into iOS. I mean, how can Apple integrate software from a business they are actively suing over hardware? It's like inviting someone to a collaborative dinner party while actively suing them for stealing your recipes.
Yeah.
How does the market price in that kind of awkward partnership?
It is definitely awkward. The market evaluates this by acknowledging the extreme pragmatism of technology giants. These companies operate in a constant state of co-opetition.
Co-opetition, right?
Yeah, they routinely sue each other over patents in one jurisdiction while signing multi-billion-dollar supply contracts in another. I mean, look at Samsung. They manufacture screens for Apple while simultaneously battling them in smartphone market share.
That's true. They do.
However, this specific lawsuit makes investors question the longevity of the ChatGPT integration.
Right, because if the relationship sours to the point of breaking, Apple is forced to find another partner. And that consumes time, engineering resources, and really risks frustrating their consumer base.
Exactly. It introduces execution risk to Apple's product roadmap. If Apple abruptly pivots entirely to Alphabet's Gemini or, say, a rushed in-house solution because the legal battle with OpenAI becomes too toxic, the seamless user experience Apple is known for could really suffer.
Which is their whole brand.
Right. So the market prices in that execution risk by tempering expectations for the adoption rate of Apple's near-term AI features.
Finally, let's evaluate Qualcomm, ticker QCOM. Qualcomm designs the processors that power the majority of the world's Android mobile devices. And they face a genuinely mixed impact here, don't they?
Very mixed.
Because on the positive side, a proliferation of entirely new AI-first devices built by startups or new entrants creates a massive new category of edge computing chip opportunities. Qualcomm basically wants as many hardware makers in the market as possible.
Qualcomm thrives on hardware diversity. If OpenAI successfully launches a new category of consumer device, other manufacturers will inevitably scramble to build competing products, and all of them will require Qualcomm's edge AI chips.
But on the flip side,
conversely, if OpenAI's launch is severely delayed by a court injunction, that removes a highly anticipated catalyst for new hardware demand from Qualcomm's future pipeline. A delay is a net negative for their immediate growth prospects regarding edge AI, even if their core smartphone processor business remains perfectly steady.
Got it. So bringing all these mechanical and financial threads together, the final trading takeaway for you, the listener, really revolves around timelines and corporate relationships. The central question is whether the court process merely slows OpenAI's hardware ambitions or if it permanently fractures the broader AI partnerships.
That is the pivotal question. If we observe a protracted legal delay, the market heavily favors established mobile ecosystems like Apple and Alphabet, alternative AI platforms like Meta, and the enterprise cybersecurity companies like CrowdStrike and Palo Alto Networks. Those companies monetize the friction.
But a rapid resolution changes that completely.
It does. A rapid resolution, perhaps through a quiet settlement and a licensing agreement, alters that dynamic entirely. It allows OpenAI to continue building a physical device that changes how consumers access applications. In that scenario, pressure returns to the traditional smartphone manufacturers, and the growth narrative for the AI infrastructure providers and chip makers accelerates right back to its previous premium.
Well, we have analyzed the immediate market reactions and the underlying mechanisms driving these valuations today. But before we finish, I want to leave you with a final thought to ponder that builds on everything we discussed today.
Let's hear it.
We spent an immense amount of time analyzing who will manufacture the best AI hardware and which chip makers will supply them. But if AI-first hardware does eventually replace traditional smartphones, operating entirely through voice commands, ambient sensors, and contextual awareness, will physical screens and premium hardware eventually become irrelevant?
Oh, that's a wild thought.
Right. Could we be heading toward a future where the physical device in your hand is just a cheap, commoditized piece of plastic, leaving the technology giants to be valued purely on the proprietary software models they guard? Definitely something to think about. This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.